And welcome to the Retire Early, Retire Now podcast. I'm your host, Hunter Kelly, owner of Palm Valley Wealth Management. And today we are going to talk about 5 tax basics that every high income earner should know. This will help you get a better understanding of where your tax dollars are going, but also help you minimize that tax bill moving forward. Once you understand these basics, then you can start looking for opportunities to help you save on taxes. But before we jump in, go ahead and share this podcast with your friends. Tax season is upon us. January will be here before we know it. You'll be receiving W-2s, working on your profit and losses if you own a business, things of that nature. So would love to spread this great information about these tax basics to help you move forward in your financial journey and help you keep more dollars in your pocket. So go ahead and share that and leave a 5-star review on your favorite podcasting app. You can also find this as a video on YouTube. Just look up Hunter Kelly CFP, and then you'll see that as a YouTube video as well. But let's jump right into it. So again, like I said, we're going to talk about 5 key concepts that I think every high income earner should know in regarding to taxes. So the first thing, a lot of these are just misconceptions. So when I meet with clients, meet with prospective clients, and we start talking about taxes, a lot of times these concepts are not understood. So one, I just want to go over these, but 2, you need a good understanding of these so that you can understand your tax situation a bit better. So the first one would be taxes are marginal. So what does this mean? So taxes being marginal means as you earn more income, you will be taxed at a higher rate on those new dollars coming in. So as it stands now, if a tax earner is making tax paying, if an individual is making more than, let's say, $200,000, this means that the top dollar, so the $201,000, that last dollar will be taxed at a different rate than that first dollar that came in, right? So our tax, again, our taxes are marginal. So those last dollars will maybe tax at a 24% rate, depending if they're filing jointly or as a single person. But that first couple of months technically would be taxed at like a 10 or 12% tax rate, right? So forget about deductions and things of that nature right now. But so as you earn more money, that tax rate on those new higher dollars coming in will be taxed at a larger percentage. And so this can be good in a sense that a couple of things. One, if you look at it from like a economy standpoint, if you're making more money, then quote unquote, you're paying more of your share toward the federal government and those taxes towards Social Security, Medicare, things of that nature, versus someone that is lower income, having to spend 30 to 35% of their income toward taxes. Obviously, someone making $50,000 paying 30% versus someone making $500,000 making 30% is a bit different. Yes, the person making $500,000 is gonna pay more of a dollar amount, but they would also have quite a bit left over as well. So it's a good thing for our lower income earners that they don't have to pay as such a high rate as our higher income earners. But also it gives you opportunities to plan for your taxes with such timing strategies, right? So, for example, if you have a year where maybe you have a lower income year, this could be a good time to do either Roth contributions, maybe because you've been making too much. You haven't had the ability to just do a normal contributions, or you could do conversions, right? So if you have large amount in pre-tax dollars and you take a year off, or you have some sort of lower income year for whatever number of reasons, you can convert at maybe a lower tax rate. So let's say that your marginal tax rate was at 37.5%. And for whatever reason, you take a couple of years off and now you have essentially no income. Well, now you can start to convert some of that pre-tax money that you would have had that you would have deferred at maybe a 37.5%, and you convert and pay, let's say, a 10, 12, even 20%, there's a big difference there. And so you'll make up that delta. The other thing that you could consider as well would be potentially selling appreciated stock, right? So if you, just like income taxes, your capital gains rates are based off your income as well. So maybe your income is low enough that maybe you wouldn't even owe capital gains rates or capital gain taxes on the particular stock, right? So if your income is low enough, I think for someone filing jointly, it's around $90,000. If you were to sell those stocks and your income was well under that $90,000, well, then now I can potentially have these gains at a 0% tax rate. Or maybe your income was such that your capital gains rate was at 20%, and now because your income has lowered, you can get it at a 15% rate. So again, these are some timing tax planning opportunities that you could potentially take advantage of in a situation where you have some fluctuating income. And so that is marginal tax rate. The more you make, the higher that bracket is going to be, that percentage on those next dollars. And so to kind of add on to that for number 2, taxes are progressive. So again, as you make more income, your tax rate is going to be higher and higher, right? So again, if you're making $50,000 versus making $500,000, your tax liability is going to grow incrementally. So again, as our tax code stands now, it starts at 10%, works its way up to 12%, 22%, 24%, all the way up to 37.5% based off your income brackets. And it changes a bit if you're single versus married, things of that nature, right? So it is a progressive system that ensures fairness, right? Or at least that's the intent, is to show fairness, to create opportunities and tax strategies like deductions and deferrals and things of that nature. But as those more high income earners earn their income, they'll be taxed a little bit more. And so it allows for those lower income earners to keep more of their money to hopefully potentially save, invest, or create more opportunities to create more income and wealth for themselves, right? The third thing, capital gains, and we kind of mentioned this just a second ago, capital gains are based off time on how they're taxed. And so a lot of people don't understand this. So if you buy a stock, let's say you buy Google today, right? December 3rd, 2024, you buy Google and you sell Google, let's say February 5th of 2025, you're going to be taxed differently than if you sold Google on December 4th of 2025. And so depending on how long you hold that stock depends on how you're going to be taxed. They're both considered capital gains, assuming you have a gain in Google, but the bracket or the amount of tax that you will pay will be potentially significant depending on how long you hold it. So if you held Google less than 1 year, it'll be taxed as ordinary income. So if your tax bracket for your income is 37.5%, those new gains will be taxed at that 37.5%. But if you held Google until December 4th of next year, you would be taxed at a lower rate, either depending on your income at a 20% rate or at a 15% rate. So that is one thing that you want to consider. How long do I want to hold this stock? It doesn't make more sense for me to hold it long term, meaning more than a year, or is my tax situation or the gain at such where it's okay for me to sell within less than a year because I've gotten enough gain out of it and I don't want to necessarily risk losing some of that gain, whatever that case may be. Obviously some things that you have to consider there, but this is why investing can be very advantageous even outside of retirement accounts, because if you're holding longer than a year, which is what the IRS is kind of incentivizing here, if you're holding those stocks for longer than a year, you're going to get a more advantageous or more favorable tax rate than if you bought and sold within less than a year. Okay. And so the next thing, right? Number 4, another kind of misconception, deductions versus credit. So deductions are something that lower your tax liability, but not dollar for dollar, right? So the common thing is if you are a business owner, right, you get some extra added expenses and deductions and things of that nature if you're purchasing those things because of the business. Well, if you go out and you buy a $10,000 widget, machine, piece of equipment, whatever you need for your business, you're not getting a $10,000 tax reduction in your payment or that your liability that you're going to owe in that year, right? You're maybe getting a $2,400 reduction or what have you. So it would almost be like going out and buying or putting $10,000 worth of shopping spree on your credit card, knowing that you're going to get a 2% reward, right? So it doesn't make sense to spend $10,000 to get $2,000 back, right? Or $200 back. So you really have to think about this, right? And understand the difference on what a deduction is and what it isn't. Obviously, if it's a piece of machine or technology, whatever you're spending that money on for the business, or something in your personal tax return that you definitely need, then obviously purchasing that will reduce your tax liability and it will be a good thing, right? And so the other thing I do want to mention here is itemizing versus the standard deduction. When Trump came in 2016 and then implemented his new tax bill, pretty much everybody at this point uses the standard deduction. And all that means is that the IRS is giving you a deduction off the top from your income. So if you make $100,000 a year and you take that standard deduction, let's say you're married filing jointly, your joint income is $100,000, where you're going to get about a $30,000 deduction or reduction in income right off the bat. So essentially that money will not be towards your taxable income. Now, there are scenarios, and we talked about this in previous podcasts. There are scenarios where you potentially could itemize, whether that's large contributions to charity or health expenses, things of that nature. And so now there are some situations where you'll itemize, and what that means is you would actually itemize or list out the deductions that you have. So whether that be student loan interest, student loan interest, mortgage interest, charitable deductions, medical expenses, things of that nature. All of that adds up to be higher than that standard deduction, then you would be able to use that. And so that's what that means by itemizing. But if that number does not add up to more than a standard deduction, you would just take that standard deduction. And for the vast majority, especially W-2 earners, you're going to take that standard deduction for your tax return each year. And number 5, the last thing, probably the most common thing that I see people not understand and certainly should understand. If you're a W-2 employee and you receive a bonus, let's say you're making $100,000 a year as a base, and a lot of your income is based off performance, and you get bonuses at the end of the year, beginning of the year, whenever that is. Let's say you get a $20,000 bonus. That is not taxed extra. It is just counted as your normal income, like you got paid throughout the year. The IRS does not see it as anything differently. Now, sometimes your employer will withhold extra, so usually about 22% is the federal mandate. Sometimes you can get to them early and say, hey, don't withhold as much, things of that nature. You can change your W-4. But the bonus that you receive is not taxed more. If for whatever reason they withhold more because of the federal mandate, and it's more than what you would actually end up owing on taxes, you would get that back in a tax refund, right? So, again, if you receive a $10,000 bonus, it's not going to be taxed differently. It would be taxed at your normal income bracket. So if you're in the 22% bracket, 24% bracket, that's where that extra money would be taxed. So just remember that sometimes the bonus will feel smaller because of what they're withholding. But if they're withholding more than what you'll actually owe at the end of the year, you'll end up getting that back. Obviously, nobody wants to give a loan to the government because they don't pay interest. But just know that you'll end up getting that money back, and see if there's a way that you can have them withhold a little bit less, if that's a possibility. So those are the 5 basics that I think most people either misunderstand or should definitely know about the tax code and how taxes work. So again, bonuses are taxed as normal income. Deductions are not a dollar for dollar reduction in taxes. So be careful, especially if you're a business owner just purchasing things to get quote unquote a deduction. You're essentially spending money to get a smaller amount back or reduced off of your tax return. Capital gains are based off time, right? They are not based off how much you make or things of that nature. They are, but the longer you hold them, the more favorable that tax rate will be. And then taxes are progressive and marginal. So the more you make, the more you will pay. And this is to hopefully help people that don't make as much, and the ones that do help out as far as Medicare and Social Security as well. So we'll do it for today. Again, I appreciate everybody listening. Hopefully you find this helpful. Hopefully everybody's Thanksgiving was a great one. I had a great time visiting with family and friends, and I look forward to more holidays coming here soon. And we'll be back next Tuesday with a good one, and we'll see you soon. This podcast is for educational purposes only. It is not meant to be financial, legal, or tax advice. Please seek a professional about your specific situation. Keep Palm Valley Wealth Management in mind when making those considerations.